You ever come across those stories, that just kind of make you rethink everything you thought you knew?
Oh, yeah, totally.
So there's this guy, Ronald Reed, um, spent 25 years as a gas station mechanic,
Okay.
then another 17, believe it or not, sweeping floors at JCPenney.
Wow.
Lived in this really modest house. I think it was like 12,000 bucks, same one for decades.
Simple life.
Yeah, chopped wood for fun,
Oh.
like totally unassuming, right?
Sounds like it.
Okay, so then he dies in 2014. He's 92.
Right.
And here's the kicker.
Yeah.
The guy's worth over $8 million.
No way.
Yeah. Let that sink in for a sec. Out of all of the Americans who died that year, over 2.8 million, fewer than 4,000 had that much wealth.
That is wild.
And get this, no inheritance, no lottery win,
Right.
just quietly saving what he could for decades, investing in blue chip stocks.
Really puts things in perspective.
Yeah, totally. It shows you, the power of thinking long term and letting compounding do its thing. Even if you start small, it can really snowball, right?
It's amazing how much it can grow over time.
So that's kind of the jumping off point for our deep dive today.
All right, love it.
We're going to unpack some really key ideas about money and wealth, how we make financial decisions.
Should be interesting.
Yeah, drawing on Ronald Reed's story and some other fascinating examples. So the goal is to give you a clearer understanding of what really matters.
Cut through the noise.
Exactly, cut through the noise. So one of the first things that really jumped out from all this research, right,
Yeah.
is this idea that when it comes to money, no one's crazy.
Interesting. What does that mean?
So basically, every financial decision we make, it makes sense to us at that moment.
Makes sense. I guess it has to, right?
Right. Even if it seems totally bonkers to someone else, it's all about our own experiences, our beliefs about money.
Our own story.
Exactly, our own story. So take lottery tickets. Americans spend more on those than on movies, video games, music, you name it, combined. Yeah, and it's often those with less who spend the most.
Even though they might not have, emergency savings.
Right, exactly. Logically, it makes no sense. The odds are so slim.
So why do they do it?
Well, if you're struggling to make ends meet, right, that tiny chance of winning big, it's hope.
It's a dream.
Yeah, a dream, a way out. Maybe they've seen people win or heard stories.
So their perspective is just totally different.
Totally. It makes you think about your own choices, right? Why do we save? Why do we invest the way we do?
It's all connected to who we are.
It really is. Okay, here's another big one.
Hit me.
The whole luck versus skill thing when it comes to success with money.
Yeah, that's a tough one.
It's so easy to look at someone wealthy and think, oh, they're just brilliant. Or the opposite, someone struggling and think, bad luck.
But it's rarely that simple.
Right. There's this story about Bill Gates. So his school happens to have a computer when he's a kid.
Huge advantage.
Total luck, but shaped his entire path.
Right place, right time.
Then you have Rajat Gupta. Right. Becomes CEO of McKinsey. Super successful.
But
Insider trading conviction. Career over. So was his success all skill?
or was there some luck involved too?
And was the downfall all his fault? Or did he just get caught taking risks that many take?
Interesting questions.
Then there's Benjamin Graham,
Mhm.
the godfather of value investing. Huge success.
I know his book, The Intelligent Investor.
Exactly. But get this, a big chunk of his gains came from one lucky Geico investment.
Really?
And it actually went against his own rules.
Wow. Talk about irony.
Then you have these guys like Vanderbilt, right? And I got the power, taking huge risks.
Old moves.
And they paid off.
Hmm.
But it could have gone the other way so easily.
Thin line between brilliance and recklessness.
So, the point is, we got to be humble.
Both about our wins and others.
Exactly. Luck plays a role, whether we admit it or not.
Adds a whole new dimension to things.
Okay, ready for a real head scratcher.
Always.
This whole idea of never enough.
Never enough of what?
Money, success, whatever it is we're chasing. It's the goalpost keeps moving.
Ah, I see. We always want more.
And it can be a real problem.
How so?
The example they give is imagine you're a rookie baseball player, right? Making good money.
Living the dream.
But then you see Mike Trout's contract.
Whoa, yeah.
And suddenly you feel kind of poor.
I can see that.
Then Trout's looking at hedge fund guys. They're looking at Buffett and Bezos. It never ends.
Always someone above you.
Exactly. And this constant wanting more, it makes you take dumb risks.
Like what?
Like this Rajat Gupta guy, right?
Yeah.
Already had $100 million.
That's more than enough for anyone.
Right. But he wanted to be a billionaire. So he gets involved in insider trading, loses everything.
Wow. He risked what he had for what he didn't need.
Exactly. So, like, it makes you ask, what's enough for me?
Big question.
Because once you know that, right, you can stop taking unnecessary risks.
And actually enjoy what you have.
Totally. Okay, now let's talk about something everyone loves.
What's that?
Compounding.
The magic of compound growth.
Right, but here's the thing. It's kind of counterintuitive.
How so?
Well, think about Warren Buffett. He's like the poster child for compounding, right?
Definitely.
But get this, most of his wealth, we're talking over $84 billion, came after he turned 50.
Really?
Yeah. And $81.5 billion after he was 65.
That's incredible.
So it wasn't like he was making these crazy returns every year.
It was consistency over time.
Exactly. Time is the key ingredient. Like his average annual return is around 22%.
Which is fantastic,
But there are guys who've done way better, like Jim Simons. He's compounded at like 66% annually since 1988.
Wow.
But he started later, so Buffett, with his lower returns but way more time, ends up wealthier.
Time's the secret sauce.
Right. They actually ran the numbers. If Simons had been compounding at 66% for as long as Buffett,
He'd be ridiculously wealthy.
quadrillions. Can you imagine?
It's hard to even fathom.
It's like, you know, those slow, gradual changes that form ice ages.
Yeah, small changes over time.
A little bit of snow each year, but over millennia. Huge ice sheets.
It all adds up.
Even Bill Gates, right, super smart guy.
No.
But even he underestimated Gmail's 1 gigabyte storage.
Back then, it seemed like a ton.
Right. Because we think linearly, but compounding is exponential.
It's hard to grasp how fast it can grow.
So the takeaway is, don't get caught up chasing the highest returns.
Focus on consistency and time.
That's where the real magic happens.
Right.
Now, making money is one thing, but keeping it.
Different ballgame.
Totally. They told these stories about Jesse Livermore and Abraham Dramansky.
Who are they?
So Livermore was this legendary trader, made a fortune during the 1929 crash.
So he was good at making money.
Amazingly good. But then he lost everything a few years later, took his own life.
Oh, wow.
Dramansky, on the other hand, was ruined by that same crash.
So both experienced huge losses.
But the difference is, Livermore was brilliant at making money, but not at keeping it.
And Juransky. We don't know what happened to him, but it sounds like a similar story.
Right. And then there's Buffett again. His success isn't just from picking good stocks.
It's from surviving recessions,
Yeah.
avoiding debt, maintaining his reputation.
Exactly. He stayed in the game. And this story about Rick Guerin really highlights that.
Who's that?
He was part of Buffett and Munger's early investing group. Just a sharp, supposedly.
Okay.
But he used margin loans, basically borrowing money to invest.
Okay, risky.
Super risky. When the market dipped, he had to sell his Berkshire stock.
Missing out on all the gains that followed.
Exactly. As Nassim Taleb says, having an edge and surviving are two different things.
The first requires the second.
So yeah, avoiding ruin is key, and that's where the margin of safety comes in.
Being frugal, flexible, and thinking long-term.
Right, because sometimes winning means not losing.
Playing the long game.
Exactly. Now, have you ever heard of the tails you win concept?
Can't say I have.
So it's like this, in lots of fields, right, including investing.
Yeah.
A few really big wins drive most of the results.
Oh, interesting.
Like in venture capital, most startups fail,
True.
but the few that hit it big make up for all the losses and then some.
So it's all about those outliers.
And it's not just venture capital. Even in the stock market, lots of companies go bust.
Right.
But a handful of superstars drive most of the returns.
Huh. I never thought of it that way. They even used this movie studio, Kuroko Pictures, as an example.
Yeah.
Made some huge hits.
Like what?
Terminator 2, Basic Instinct, Total Recall.
Big movies.
But they went bankrupt anyway.
So even success doesn't guarantee survival.
Exactly. Which is why staying invested is so important.
Even when things get rough.
They give this example with 3 investors, Sue, Jim, and Tom.
Okay.
Sue just invests a little bit every month, consistently.
Makes sense.
Jim and Tom try to time the market, selling during downturn.
Try to buy back in lower.
But guess what? Sue, who just stayed put, ends up way ahead.
Because she caught those big tailwinds.
And the other thing is, failure is part of the process.
Even for the most successful people. Like Jeff Bezos says, they were working on even bigger failures than the Fire Phone.
Knowing one might become the next AWS.
And Netflix's CEO, Reed Hastings, wants a higher cancellation rate.
Why would he want that?
Because it means they're taking enough risks trying new things.
It's all about experimentation.
Like Chris Rock testing out jokes in small clubs.
Most of them probably bomb.
But the ones that kill end up in his specials.
So we only see the hits.
And George Soros has this great quote, "It's not whether you're right or wrong that's important.
But how much you make when you're right and how much you lose when you're wrong."
So it's not about being right all the time.
It's about managing your wins and losses.
Exactly. Okay, let's talk about something everyone wants.
What's that?
Freedom.
Oh, yes.
What does money really buy us?
Well, I think it can buy us freedom. The freedom to do what we want, when we want.
With who we want, for as long as we want.
That's the ultimate goal, isn't it?
It is. And honestly, it's way more valuable than any fancy car or house.
I can see that.
I remember one summer I interned at an investment bank.
Oh, yeah.
The pay was insane for someone my age,
Sounds good.
but I was miserable. No control over my time.
So the money didn't buy happiness.
Nope. Then there's a story about Derek Sivers' friend. Saved up a decent chunk of money,
Not a huge amount, though.
but it was enough to quit his job and become a full-time musician.
That's awesome.
And it made him so much happier.
Freedom to pursue his passion.
Makes you wonder, right? America's one of the richest countries.
But are we happier than we were in the 1950s?
When we were much poorer. Doesn't seem like it.
Maybe it's because our relationship with work has changed.
We're always on, even if we're not technically working.
Makes freedom even more valuable.
So it's not just about having money.
It's about what it allows us to do.
Exactly. Control our time, live life on our terms.
That's the real prize.
Now, this next one's kind of sneaky.
Tell me more.
It's about how wealth is what you don't see.
What does that mean?
We judge well by the stuff people have, right?
Cars, houses, clothes.
But true wealth, it's what you haven't spent.
Interesting. The money in the bank.
Exactly. The investments.
Yeah.
The options it gives you.
Not the things you've already bought.
Right. They tell the story about Rihanna.
Oh, yeah. The pop star.
So her financial advisor told her, spending $1 million just means you have things, not that you are a millionaire.
Sounds obvious, but...
But it's easy to get confused, like wanting to spend like a millionaire versus actually having $1 million in net worth.
Two very different things.
It's like, being rich versus being wealthy.
Rich is high income.
Yeah.
Wealthy is accumulated assets.
And the analogy they use is the oil crisis in the 1970s. We didn't solve it by finding more oil.
We did it by using less.
Becoming more efficient. And it's the same with money. It's not just about earning more.
It's about saving more.
And that's more within our control than investment returns.
It's the gap between what you earn and what you spend.
That's where true wealth is built.
Okay.
Ready for a curveball? So this one says, maybe being totally rational about money isn't always the best approach.
Really? Why not?
Because in the real world, emotions play a role.
Ah, I see.
So they talk about this guy, Julius Wagner Jaureg. Back in the day, he used fevers to treat syphilis.
That sounds kind of crazy.
Right, making sick people even sicker. But it actually worked. He won a Nobel Prize.
Wow.
Because we now know fevers are the body fighting infection.
Like a natural defense mechanism.
And they say it's similar with money. Trying to avoid all discomfort, all risk.
Can actually hurt us in the long run.
Exactly. Like with fever phobia, we panic over a little temperature.
Even though it might be helping us.
And same with investors. They freak out during market dips, make bad decisions.
Driven by fear.
Even Harry Markowitz, right, the guy who invented modern portfolio theory, super rational.
Yeah, he was all about math and diversification.
But even he didn't follow his own models perfectly when investing his own money.
Really?
He considered things like personal preference, aversion to certain investments.
So he was being reasonable, not just purely rational.
Exactly. Because following a plan you hate.
You won't stick with it.
You'll abandon it at the worst possible time.
So it's about finding a balance.
Right. Whether it's a little home bias, a tiny bit of speculative investing, or even Jack Bogle, Mr. Index Fund himself, investing in his son's active funds.
For family reasons.
Exactly. Sometimes being pretty reasonable is better than being perfectly rational.
Makes sense. It's about what works for you in the long run.
Here's something to think about. Stanford professor Scott Sagan said, "Things that have never happened before happen all the time."
That's a good one.
Right. And it's especially true with money. History's useful, but it's not a crystal ball.
So much can change.
Like, Imagine trying to predict the Great Depression, World War II, 9/11, the 2008 crisis.
Possible.
And these events have shaped the world we live in, economically and otherwise.
Totally. And then there are all the structural changes in the markets themselves.
Like the rise of 401k, venture capital, changes in the S&P 500.
The rules of the game are constantly evolving.
Even Benjamin Graham's value investing formulas, they worked great in his time.
But the markets are so different now.
It's like card counting in blackjack.
The odds can be in your favor.
But any single hand can go either way.
You got to be humble about your ability to predict the future.
Exactly. Which brings us back to the importance of room for error.
Having a buffer for the unexpected.
Because unforeseen stuff will happen.
Always does.
Wars, company failures, natural disasters, recessions.
You name it.
And leverage, right? It can make you rich.
But it can also wipe you out.
Turn small risks into huge problems. So a barbell approach can help.
Taking some risks, but also being very conservative with another chunk.
Ensures you survive. Like even Buffett wants a successor who can avoid risks never before encountered.
Smart move.
So having that margin of safety, super important.
It's what lets you stay in the game long enough to win.
And speaking of long games, here's something to consider. You'll change.
What do you mean?
We all change over time, right? Our goals, our desires, even who we are as people.
True.
But we tend to underestimate how much. It's called the end of history illusion.
We think this is who we'll always be.
Like that investment banker who got his dream job, then hated it.
Because he changed.
So we need to build that into our financial plans. Like Ronald Reed and Buffett, they were super consistent for decades.
Incredible discipline.
But for most of us, life throws curveballs.
Our priorities shift.
It might be helpful to think of our financial life in 20-year chunks.
More flexible that way.
And avoid going to extremes, whether it's super frugality or chasing ever higher income.
You might regret it later.
Because here's the truth, nothing's free.
Everything has a cost.
Especially in finance. Volatility, uncertainty, doubt, regret.
It's all part of the package.
Like Jeff Immelt said, every job looks easy when you're not the one doing it.
Investing's the same way. It looks easy from the outside.
But then you gotta actually live through those market swings.
Not so easy then.
Studies show that tactical mutual funds, the ones trying to time the market,
They often underperform.
because they're trying to avoid volatility, which is like an entry fee.
The price of admission for potentially higher returns.
And individual investors do even worse because of bad timing.
Buying high and selling low.
Driven by emotions. And GE under Jack Welch, they manipulated earnings to make things look smooth.
But it all came crashing down.
They were trying to avoid the cost of volatility.
And ended up paying a much bigger price.
It's like that saying, smooth seas never made a skilled sailor.
You gotta weather the storms to get where you're going.
Now this brings us to the whole you and me dynamic.
Meaning what?
We all have different financial goals, different time horizons.
Different risk tolerances.
Which is why bubbles are so hard to learn from.
What one person sees as overvalued, another sees as a great opportunity.
There's no single rational price for anything.
Depends on your goals.
So we got to be careful about listening to advice that might not apply to us.
Someone playing a different game.
Exactly. A day trader has a completely different outlook than someone saving for retirement.
So know what game you're playing.
That's the first step to making good decisions. And here's something else to consider. The seduction of pessimism.
Meaning?
Pessimism is more common than optimism. It sounds smarter, it gets more attention.
It's like bad news sells.
Real optimism, though, isn't about being naive.
It's about believing the odds are in your favor over time.
Even though there will be setbacks. Like, think about it. If someone had predicted Japan's amazing post-war recovery back then,
They would have been laughed at.
but the doom and gloom predictions about America in 2008,
Front page news.
and most financial newsletters are full of warnings and predictions of crashes.
Even though the market has historically gone up over time.
It's because we're wired to focus on threats.
It's a survival instinct.
And losses feel worse than gains.
They hit us harder emotionally.
Plus, bad news is often more sudden and widespread,
A market crash affects everyone.
while progress is usually slow and gradual.
Like the Wright brothers. No one cared about their first flight.
But a plane crash.
Big news.
So pessimism is easier to spread and more attention-grabbing.
It feeds on our fears.
But optimism takes a longer view. And Stephen Hawking, the physicist,
Yeah.
he said, I have found it a good rule to reduce my expectations to zero.
Meaning.
If you expect nothing, you're never disappointed.
Interesting perspective.
It's like imagine an alien observing New York City in 2007 and then 2009.
During the financial crisis.
Would they see much difference? Probably not. The buildings are still there, life goes on.
But the stories we tell ourselves, the narratives, they change everything.
They can fuel the economy or crush it.
Powerful stuff.
And this brings us to when you believe anything.
Okay.
When the stakes are high and we feel like we have no control.
We'll grasp at any hope.
Like that dad, Ali Herjaji, giving his sick son a dangerous folk remedy.
Because he was desperate.
And Bernie Madoff's Ponzi scheme. People wanted to believe it so badly they ignored the red flags.
Because they wanted those high returns.
So having room for error, flexibility, financial independence.
These things protect us.
They help us think clearly when everyone else is losing their heads.
They make us less susceptible to those seductive narratives.
So all together now, what have we learned?
Well, financial success is about more than just numbers.
It's about psychology, experience, values.
Like with medicine, we've moved from a paternalistic approach
Where the doctor knows best.
to one that emphasizes patient consent and individual needs.
Financial advice is similar. There are some universal truths.
But how they apply depends on the individual.
So I can't tell you exactly what to do with your money,
Because I don't know your specific situation.
but I can offer some general advice.
Okay, I'm listening.
Be humble when things go right.
And forgive yourself when they go wrong.
Reduce your ego to build wealth.
The gap between ego and income is where savings happen.
Manage money in a way that lets you sleep at night.
Peace of mind is priceless.
Use money to gain control over your time.
That's the real freedom.
Be nicer and less flashy.
Respect comes from character, not possessions.
Just save, even without a specific goal.
It's a buffer against life surprises.
Define the cost of success and be ready to pay it.
Volatility is the fee, not the fine.
Worship room for error.
It allows compounding to work its magic.
Avoid extreme financial decisions.
You'll change, and your goals will too.
Now for some personal confessions.
Right, let's hear it.
My parents, they were pretty frugal.
It's a good value to instill.
It gave them independence later in life. And my wife and I, we basically kept the same lifestyle we had early on.
Even though your income is increased,
Yeah, so we save a lot.
and that gives you freedom.
It does. Plus, it takes the pressure off keeping up with everyone else.
Makes sense. What about investing?
I just invest in low-cost index funds.
The classic bobblehead approach.
Yeah. We live simply, so we don't need to take crazy risks trying to beat the market.
Works for you.
It does. Now, stepping back a bit, it's amazing how much the economy has changed. Right.
Fast and unpredictable.
Like the wealth gap, all these global shifts, it's hard to make sense of it all.
And our intuition is often wrong.
Even the post-WWII boom, right? Low interest rates, consumer spending, productivity.
Led to more equality for a while.
But then things shifted again. More inequality, more debt.
History's a funny thing.
It really is. So that's our deep dive into the psychology of money.
Thanks for exploring this with us.
Hopefully you see that it's not just about numbers.
It's about understanding ourselves and others.
Think about the things we talked about.
How do they apply to your own life?
And here's a final thought to chew on. Given all the surprises and quirks of human behavior, what's one small, reasonable change you can make to your financial approach this week?
Something to ponder. Thanks for listening.
We'll see you next time.